Well, the next important question, I think, whenever infra change, it comes down to incentives. Basically, everyone want to understand this. So if tokenization scales, who benefits first? Is it I'm an issuer, investor, asset manager? Who's that?
Similar to the example I gave with the internet and how it ultimately benefited both the consumers and the content creators, but it
Okay.
put pressure on the people in the middle. I think it's similar in tokenization. You have investors on one side and you have issuers on the other, and both benefit from this. But in the middle, there's lots of parties that extract rent, whether that be kind of people that temporarily buy loans and then sell them or securitize them, but don't ultimately own that security in perpetuity in the loan space, or whether it be people in the equity space that focus on custody or brokerage, prime brokers, all those types of people that kind of make their business in the middle. I
Okay.
think that's going to get squeezed by tokenization, similar to how the internet squeezed a lot of the publishers and the distribution, and then
Mm.
kind of and then return power on both ends to the market.
All right. I see. Michael, tokenization model sounds really good. It sounds better. In some places in practice, in some places in theory, but so far it seems to me the adoption is slow. How do you solve the cold start problem?
The example that I gave with what Figure did in home equity, I think is a
Okay.
perfect example. And so you also you have to look at what I call hair on fire problems, right?
Okay.
Where is someone's hair on fire? And so what you had in the past couple of years in home equity was 35 trillion of home equity, lots of people with uh, mortgages that were in the money, and so people wanted to take out home equity loans on top of that, and Figure made that really easy and used blockchain to do it. Now in equity, I think there's a few examples where it would be really powerful to have a tokenized approach. One is where there's lots of short interest, because when you have a lot of people shorting your stock, someone's
Okay.
making a lot of money on that borrow, but it's the prime broker. And if you're an issuer, you obviously don't like people shorting your stock and you prefer your investors to accrue those economics. So you should say move to the blockchain and let your investors own the upside in all the people that want to borrow the stock for shorting it. And so you can acknowledge that reality. That is a hair on fire problem. I think digital asset treasury companies, DATs, that are trading below NAV have a hair on fire problem. If they move to the blockchain, they can actually distribute out the underlying token or treasury to kind of close the gap between net asset value and the share price. And
All
that's
right.
another example. So I think you have to focus on these quote, and this is how any disruption happens, right? All of the Y Combinator companies that have been successful focused on a serious problem. They
Mm.
didn't give technology for technology's sake. Nobody signed up for the early payroll softwares because they wanted to use technology. It's because they had a problem paying people, right? And
Yeah.
so I think people sometimes miss this with blockchain. It's technology, and you need to focus on the uses of it, not the technology itself.
Yeah. No, it's a good analogy.